Hi, I'm Ben Brundage. I head up our investor relations team. I'm joined by Matt Riccadella, our founder here at Crystal View Capital. Today, we're really excited to share that we've had a two-park portfolio. This is 360 sites that we purchased back in Q1 of 2024, just go through a refinance. So this was agency debt. Matt, would you tell
Yeah.
us just some of the details here of these properties and this refinance?
Yeah, I'd be happy to. Let me give you, we're really excited about this transaction, by the way, but let me give you the higher level deal points here. We just closed on a Freddie Mac refi, $12.773 million, represents 65% loan to value. We locked this debt in at 5.96%, and that's fixed for 10 years and it's full term interest only. So, really, really attractive debt. Here's what we're also excited about. We were able to pull out essentially 88% of our equity. So we only have 12% of our initial equity in this deal. This was originally an all cash transaction. We purchased these parks for $14,250,000, as you mentioned, back in Q1 2024. They appraised in Q2 2025 for $21 million. So that's a 67% increase in value in a little bit more than a year. The way we did that is we grew NOI by 82% during our ownership. So we took NOI from 700,000 at acquisition to roughly a million 275 presently today. And that was driven in large part by an 18% increase in rents and our ability to pass through utilities. I will also mention that we made some significant improvements within these communities. So we've remodeled the community clubhouse, we've installed the new bus stop in one of the communities, and we put in new playgrounds to kind of give back and to increase that pride of ownership within these communities. Also, what's noteworthy is we have a very robust park infill program in place right now where we're actively filling vacant sites in both communities. And our occupancy growth is actually ahead of projections. We're just really excited about this transaction and the performance of both of these communities within the Fund 4 portfolio.
Yeah, sounds like stellar performance here. Matt, I wonder if you could speak a little bit more to those terms that we got on this refinance. Those are
Yeah.
pretty spectacular terms for today in today's world in the economy.
Yep.
How
Sub
did we get those
6%.
terms?
Yeah, sub 6%. We're obviously very, very excited about that. I think in large part it's our relationship with the agencies. You know, we've been out there and we are an active borrower with both the agencies, Fannie and Freddie, for about 10 years now. We started in our fund two borrowing with the agencies, and actually fund one was our first deal with Freddie Mac. And when you have a good reputation, you could actually command a little bit more of an attractive rate through the spread. The spread is the difference between the rate and the 10-year treasury. So, because of that relationship and because of that long track record, we were able to kind of really negotiate a very attractive rate for our investors in Fund 4.
So, Matt, with the 12% equity that's left in the deal, what does this mean for our new cash on cash? Where are we at?
Yeah, well, I will say this with the 12% that's left in the deal, our cash on cash returns after paying debt service are going to be 33% in this transaction. So, really stellar cash on cash returns across the board on this one.
Wonderful. Now, this is a Fund 4 transaction, just in Fund 4. What do these proceeds mean for Fund 4 and for those LPs?
Well, I mean, it means that basically we were able to invest in a deal, pull all of that cash out effectively. There's only, again, 12% left in the deal, and we could rinse and repeat. The idea here is to go out, find another deal commensurate with this one, and invest those funds and repeat that process again. Go in there and execute that value add business plan. And hopefully in the future, go back and refi cash out of that next transaction is just a compounding effect that has a very, very material positive impact to our LPs.
Wonderful. Well, you mentioned that we've remodeled the community room and installed new bus stops, all this new things playgrounds that have gone into effect at these properties.
Yep.
We've got Derek Burgeon, our COO, who's going to talk a little bit more about how operations implemented those improvements, park infill, and really drove that NOI up at these properties specifically. So we'll turn it over to Derek.
Yeah, thanks, Ben. So we're really proud of these two assets, especially as we look at Clover in Muskegon, Michigan. You know, when we purchased this property, we came in with a value add strategy that we needed to get to work right away to really extrapolate the most out of this property right out of the gate. And so we increased the monthly revenues by 30% by month three. And that was done through rate increases, implementing some fees like pet fees, late fees. And then by month four, we had doubled the NOI, right, as a byproduct of those efforts. We also had recaptured about 184,000 in annual utility expense, which you apply a 6.5 cap rate to, adds about $6.1 million in value to that property. Additionally, we've billed back school taxes. We've implemented cable and internet services on top of providing a new playground, updating the bus stop, and some other community center enhancements that we've done for our residents there to help justify or support the rental increases that we have implemented to date and for future rental increases that we have on the docket in subsequent years. And this has all resulted in this park being 98, 99% full with projected IRRs around 25%. So on our Fairfield property, which is located in Bay City, Michigan, we purchased this property in December of 2023 and went to work immediately on our value add proposition here. We did rental increases in month two, water reimbursements in month two, which generated about a 31% increase in revenues. That was with a 16% increase in rent rates in the first year. We also filled 4 sites, which drove about $2.2 million worth of value. Over the next subsequent years, we're going to continue to dial up our reimbursements and rental increases to bring this park to market rent. And it's obviously displayed another success story for Crystal View Capital in our value add proposition, what we do when we go in and buy properties and get the most value out of it as quickly as possible.
Wonderful, wonderful. That's significant. Could investors, yes, we've done this refi, we drove this value, but what can investors expect for these properties moving forward?
Yeah, we're going to continue to focus on extrapolating value, which is we're going to be implementing continued rental increases to bring this property to market rents, which when we purchased this, it was severely under market. Additionally, we're focused on infill, bringing new homes into the park where we can, selling those, and it immediately adds NOI value to a property when you're able to do that. This has been a very strong market for us, both from a rental and home sales, and we're excited what the future may hold as we continue to bring in new tenants and add value to the park.
Well, thank you, Derek. These sorts of activities are happening all the time here at Crystal View. If you have specific questions about these assets or this refinance, please reach out. Additionally, Fund 4, this fund is currently open and accepting capital. We've got a robust acquisition pipeline ahead of us here. And so if you have questions about how we think about and model these value add strategies and refinances, we would love to talk about that. We're happy to share more information with you. You can send an email to invest@crystalviewcapital.com or schedule a call. Give us a call anytime. We would love to get into the weeds together. We look forward to talking with you.